So you made a lot of money this year. First off, congrats. That's a great problem to have. But now comes the part that nobody likes, figuring out exactly how much of it you're going to keep. Because if you don't do anything between now and the end of the year, the IRS will happily take a big chunk right off the top. But the truth is, you've got options. And in this episode, I'm walking you through a full menu of tax strategies you can use before the year end to lower your tax bill and keep more of what you earned. We're covering everything from estimated tax payments, prepaying expenses, real estate moves like short-term rentals and syndications, retirement accounts, and solo 401ks, and even G-Wagons and oil and gas investments. So if you made a lot of money this year from your W-2, your business, your rental property sales, the first thing you need to do is get your estimated tax payments in. And the reason is because the IRS wants your money as soon as you make it. Now, if you're a W-2, you've been doing this through your paychecks every month. If you sell a rental property, the IRS doesn't actually know that you sold the property, and therefore they don't know that you made the income. But you know, and you have to submit that payment. And by not submitting payments, it leads to penalties and interest. And the interest used to be a small amount, like 3 or 4%, barely kept up with inflation. But now in 2025, the interest is 7%. And it's also a 0.5% per month penalty on how many months you're late. So these fees can add up. Like on a $100,000 tax bill owed, you're going to pay another $4,500 to $5,000 in penalties and interest alone. And that's a lot of money. We give enough money to the government. We don't need to give them any more. And that's why getting estimated payments in is very important. Now, here's exactly how to do this. There's 3 ways you can do estimated payments. The first way is to do absolutely nothing. And I would highly encourage you not to do this because it's going to rack up the most penalties and interest. Doing absolutely nothing means you just wait until you go to file your tax return in April and you pay the entire balance plus the penalties and interest that are due, and I don't recommend this. The second option, which most people use, is to give to the IRS exactly the least amount of money possible that they need throughout the year by December 31st. That way they don't charge you penalties and interest. Now you still pay when you go to file your tax return, the remaining balance, but at least you don't pay penalties and interest along the way. And this amount that you need to pay in by December 31st of this year is 110% of your last year's tax bill. So if you go and look at your last year's tax return, go to line 24 and multiply that number by 110%, that's how much money you need to pay in by December 31st of this year in order to not incur penalties and interest, okay? And then the remainder you'll pay on April 15th. The third way to do this is to give the government everything that they need before the end of the year. And then when you go to file your tax return, you don't get money, they don't get money back, you break even, and everybody lives happily ever after. Now, most people don't want to do the third option because then it will require them to pay the cash on December 31st versus some of that they could be paying on April 15th or when they go to file their tax return. We want to keep as much money in our pocket as possible and pay it at the latest time that we can. Now, the next strategy you might want to consider is prepaying future expenses. Now, we are all cash basis taxpayers, which means we get a tax deduction when we pay for the good or service or product, right? So if I do this with my portfolio and my businesses personally, is towards the end of the year, I will look at all the expenses and everything that I have coming up in, say, January, February, or March, and I'll prepay that this year, November or December, because I get to write it off in the year that I pay it, not the following year, right? So I might use the cleaning supplies next year, but because I paid for them and bought them this year, I get to deduct it this year. So go look at all your rental properties. If you got 3 or 4 properties, think about all the stuff you're going to need from January through April and go put that on a credit card in November and December. Why? Because you get the deduction this year, but the credit card you can pay off monthly or you can pay it off in the future time. And so you're able to get the deduction now, but not have to pay for it in the future. And that's the best part about this strategy is you could do it as much as you want or as little as you want. It's really based on your tax bracket. Now, maybe you might want to consider what are some things that I can do that not only reduce my tax liability, but also are going to increase my net worth over time. And so I personally, our firm only recommends strategies that will not only save clients a lot of money on taxes, but also increase their net worth over time. So things like you can do a 401k, you can contribute to an IRA, sole 401k, SEP IRA. If you're at a W-2 company and they offer an HSA, a health savings account, that might be something you want to consider and invest in order to get a tax deduction now, save money on taxes, but it's also going to be worth more in the future. And this goes back to Rule 72 that I talk about, where your money is typically going to double every 8 years. Every 8 years that you're invested in the stock market, on average, it's going to double. So that 401k or that IRA contribution not only reduces the amount of taxes that you had to pay this year, but it's also going to allow you to increase your net worth over time. So buying vehicles has always been a controversial topic, but if you are a business owner and you have a high tax bracket and you also use the vehicle for work, this strategy can be perfect for you. Now, when you buy a business vehicle, here's the thing I want you to understand. Not only do you get to write off the cost on your tax return in the year that you buy it, but whether or not you pay all cash or you take out a loan for it, you still get the same tax deduction, which I think is extremely powerful. If I'm going to buy a $50,000 vehicle and I pay all cash, I get the same deduction as if I put $10,000 down and I took out a $40,000 loan. Now, obviously, you're going to have to make interest payments and probably pay that off over 5 or 7 years, but it's an option for you if you want to save money on taxes this year and you're also using a vehicle for business. Now, remember what I said earlier about you want to make sure that you're utilizing strategies that not only save you money on taxes, but are going to increase your net worth. So think about buying a vehicle. That vehicle is not going to be worth the same amount 3 years from when you bought it. So think about that long and hard before you go buy a business vehicle, because yes, it could save you money on taxes. Yes, you would look nicer driving a G-Wagon or some other expensive car, but it is going to make your net worth go down in 3 years. I can promise you that. What we like to do instead is buy assets, get tax deductions for things that not only save us money, but also increase our net worth over time. And that takes us into the next strategy, which is to buy a short-term rental. When you buy a short-term rental property, not only are you going to save a bunch of money on taxes this year, but you're also going to be having cash flow from the property. You're going to get appreciation on the property. And as long as that property is in a nice area and you don't have like a dump truck plant or it's not next to the Section 8 home, you're probably going to have that property go up in value over 3 or 4 years, as opposed to the G-Wagon that you buy that's going to go down over 3 or 4 years. You might also want to consider buying a long-term rental and qualifying for real estate professional status, or maybe you had some capital gains before from the sale of properties. Buying a long-term rental can also have similar benefits to a short-term rental in terms of tax savings, wealth building, and everything in between. Now, here's the thing. You don't need to do all of these strategies. You actually shouldn't do all of them. You just need the 3 or 4 that apply to your situation. That's exactly what my team and I help clients with. We'll look at your actual numbers, run the projections, and show you where you've got room to save on your tax bill before it's too late to do anything about it. If you want help building your custom year-end tax plan, click the first link in the description and you can book a call on the next page. This next one might be new to you, but there's oil and gas tax strategy investments. Now, let me break this down. When you invest in the oil and gas tax benefit, you are putting money into a fund that is going to go dig and drill for oil. And when you do this, there are certain tax benefits that oil and gas investors get that other people don't get. And one of the biggest things being is that they're normally able to write off their initial contribution into the oil and gas fund against their W-2 or business income. So if you want to get a high write-off against your W-2, but you don't want to manage a rental property, oil and gas is a great tax strategy for you for this reason. But it's not just because of the tax benefits. What oil and gas provides that not a lot of people think about is diversification away from the stock market. So easiest way to explain this is if I had $1 million in my stock market account and all of a sudden there's another COVID or there's another big world event, like my stock account could go down 30% in 1 year. And now my net worth would be $700,000 as opposed to $1 million. But if I had, say, 50% in stocks and 50% in oil and gas, or what are called alternative investments, the alternative investments are not correlated with the stock market. And therefore, even though the stock market went down 30%, I only lost half of the net worth that I would have lost had everything been in one asset class. So oil and gas can be a great tax strategy play, but it can be an even more important wealth building and wealth diversification play, especially the closer you get to retirement age. The closer you get to retirement age, you can't afford to take as many risks as you did before, especially if you need that money in retirement. And oil and gas is a great tax strategy as well as a wealth diversification tool for that exact reason. Another thing you can do before the end of the year is invest in real estate syndications. And so the way this works is similar to oil and gas, is that you're going to cut a check for an amount of money. You're going to be considered passive. You don't run any of the day-to-day operations, but you get to take advantage of the tax benefits from that investment. And similar to owning a rental property, the idea with the syndication is that 3, 4, 5 years from owning it, not only are you going to get tax benefits and cash flow, but you're also going to get appreciation on your initial investments. And syndications are a great way to diversify your real estate portfolio from just owning properties to also owning other investments that might not be correlated with your portfolio. So it's similar to like owning, say, a bunch of properties in a lake market, and then you go buy a property in a beach market or a mountain market. Those markets are going to have different seasonalities of cash flows. And the same thing happens with a syndication compared to a long-term rental or a short-term rental. And the last strategy we're going to talk about today is buying a business with assets that you can depreciate. So if you buy a business that has a bunch of equipment, machinery, furniture, computers, you are actually able to write off the cost of that equipment against your active or business income. And so you could take out a loan to buy a business, and the more machinery, the more equipment, everything that's inside of the business, you actually can use that to write off against your W-2 or your business income. So I know we talked about a lot of strategies here. We talked about estimated payments. We talked about prepaying expenses. We talked about all the different types of retirement account options that you can do. We talked about car purchases, long-term rentals, short-term rentals, oil and gas, syndications, buying businesses. There's so much that we talked about here. And again, maybe 2 or 3 of these apply to you. Maybe most of them apply to you. But if you really want to know, I would take the time to learn each and every one of these just a little bit and just know exactly which one that you're going to implement for your tax plan for 2025. And if you like this video, you're definitely going to like the one here. So click on the link and I'll see you there.